What's up, everybody? Hope you're having a remarkable day. Will Lucas here, Afrotech, Black Tech, Green Money. So look, today I'm talking to Aaron Samuels, who is a co-founder and venture capitalist at Collide Capital. He was previously at Blavity, where he was co-founder and COO. Blavity is the largest millennial platform on the internet in the world. It's the biggest there is. Millennials and Gen Z, there's nothing bigger for Black millennials. So today we're talking about storytelling with founders and venture capitalists. Aaron has been at Bain Capital. He's a poet. Just check out his story. Here we go. So you've had a successful career just as a professional, and I wonder how that translates to venture capital. You know, how do you tell the story of first being able to build a good business to people who, you need their money to go invest in businesses that you believe can be really, really good?
No, I appreciate the question, Will, and it's an honor to be here. First and foremost, I feel like day one, Black Tech, Green Money.
100%.
Seeing the story build up over time, and look, I think it's a good question. So taking a step back, I think that there's many paths that people take in order to break into venture capital. I think there's three primary paths that people take, which is one, being a former operator, which is my path, and happy to dig into that a little bit. So this is either you founded a company, or you rose through the ranks to become a senior operator at a company. You learn how to do the company building fundamentals, and then ultimately that teaches you how to identify that type of talent, that type of support for other companies, right? So I think that's path number one, and how do people break into venture. Path number two is you go through the investor funnel. So oftentimes people will work in investment banking, work in private equity, maybe work at, some smaller venture capital shops, and then work their way up to the larger firms, and then maybe one day start their own, right? But you kind of have the career as an investor. And I think number three is, I think actually the most common version of becoming a venture capital practitioner, which is that you are just born rich, and you just have money.
So that's the most common.
That's actually how the industry got started. The industry got started as a cottage industry where wealthy people effectively just made angel investments as long shot bets that had very low probability of success. But if they hit super big. And it's only over the last 20 to 30 years that venture capital as an industry has really started to solidify. And so I say that because I think it's important to remember that for the majority of the history of venture capital, this was a game that rich people played by taking huge bets that were of less consequence because they could afford to lose the money that they were playing with. And it's only recently that the asset class has become formalized. And so if you want to become a venture capitalist, the easiest way to do that is to just be rich. For those of us that don't have that option, I recommend one of the former two paths, which is to be an operator or to be an investor. And my way was to be an operator. So now that we're grounded, I had a great career path that led me to this moment. And I clip from all of my experiences, from being a spoken word artist to being a consultant to being a product manager to being a COO. But I think it's important to say for all your listeners, because there might be people that walk different paths that want to find a way to get into venture. You don't have to just do it my way.
Yeah, I want to talk about that first way for a second. The people who are on a career trajectory and they say, you know what, I want to find my way here. They're an operator today. What are the things along the operational journey that are necessary to be good at this? To have learned?
Yeah. I mean, it's a good question. In many ways, I'm still figuring it out myself. The hard thing about venture, and a way that it's very distinct from being an operator, is the feedback loops are way, way longer. So, when I was COO at Blavity, I put in a solid week's worth Monday, Tuesday, Wednesday, Thursday, Friday. On Friday afternoon, you could walk into my office and ask me straight up, "Hey, Aaron, did you do a good job this week? Yes or no?" And I could
Yeah.
look you dead in the eye and give you an honest answer. Yeah,
Yeah.
I crushed it this week. This week, not so well. It didn't go as well.
Yep. Yep.
In the world of venture capital, you don't have that.
Yeah.
At the end of
For
the week on
years.
Friday, you asked me how well I did. I have no idea, and I won't know for, as you pointed out, I won't know for 7 to 10 years
Yeah.
if
Yeah. Yeah.
I'm good at this. You're making very, very, very long term, high risk bets, and the successful firms are going to be the firms that invest in 20 to 50 companies and have one or two huge winners, even if the rest completely go to zero. It's hard to call it. And so the things that you do on your journey as an operator, in theory, should help you do one of two things, which is either help you become a better picker, right? Help you pick winners, help you identify the characteristics, the attributes of founders, of markets, of operating teams, of business model ideas that will help increase the likelihood that you pick a winner. And two, learning how to support your portfolio, the things that you do post investment, which is where I think operators really shine, is after you've made the financial commitment to a company, what else can you do? Can you help them build their CRM? Can you connect them to operational leaders? Can you connect them to customers? Can you connect them to hires? And that not only will help support the portfolio company after you've invested, but if companies believe that you're going to be able to provide that type of support, it might make you more attractive as a firm to begin with, which might then help you select or help you have access to better top of funnel for the investments that you make.
Now, you raised some really interesting questions for me, and I've heard plenty of Black founders on this podcast, many who are wildly successful, talk about how there are so many VCs who want to be in on their deals, and we tend to, because there's so few of us. There's a growing number, but so few still, that just want anybody to give them a check. But there's a certain segment of Black founders who have checks thrown at them, and they get to be selective. And so then the VC is then ultimately trying to pitch themselves. So can you talk about what it's like to be on both sides of that, to where you're on the Blavity side where people want to give you money, and then you're on the VC side where you might have to pitch yourself to some really, really interesting startups?
Yeah, I mean, look, this game, if anything, will help keep you humble. Um, and look, I think that's a good thing. Like in some way, you're always pitching yourself. You're always selling something. And I think, the older that I've gotten, the more that I've realized that when you make it to the top of any field, ultimately you're a seller. I have a good friend of mine. He's a climate scientist with a PhD from Harvard. I ask him how he spends most of his days. He spends his days writing grants, which, it means fundraising, which means he's raising money for, to support the projects. I think that's the same thing if you become a great founder, if you become a great investor. At the end of the day, once you get to the top, you're raising money, which means that you're selling yourself, you're pitching yourself. And you're pitching yourself to, as a VC, you're pitching yourself to, your LPs to invest in your fund, just as much as you're pitching yourself to the founders that you potentially want to invest in. And so what it means is that you can't take anything as a given. You can't take anything for granted. To understand what your strengths are, and you need to let the founders know why it's going to be differentiated to receive a check from you, as opposed to any other lookalike small emerging manager, or they might be comparing you to a big box shop, and then I need to convince them why taking my money is better than taking money from a $22 billion Silicon Valley based firm.
Yeah. I know you're very passionate about your spoken word and poetry, and I wonder the connections you might see, if you can describe those for us, from that sort of creativity and the business creativity that you have to endure.
Yeah, I think my time traveling as a performance poet, for about a decade, I was heavily traveling around the country. Um, and I learned a lot about passion, and a lot about kind of this notion in the poetry world that we call speculative fiction. This idea of dreaming a better world and writing it into existence. And I think that in many ways there are strong commonalities between my favorite artists and my favorite founders, in that both of them are dreaming a better world, identifying a way that the world can be happier, healthier, more efficient, but improved in some way, and then building that and speaking it into existence. If you can't dream it first, then you can't then build it. And for me, that attribute of passion is something that is probably the number one characteristic that I look for in founders. I'm looking for a founder that has identified a hole in the universe that they uniquely are qualified to fill. And I think that that's so important. As we mentioned earlier in the conversation, the feedback loop is long. It takes 7 to 12 years for a venture-backed startup to get to exit. I need to know that the founder is going to be just as passionate on year 7 as they are on year 1. And that doesn't happen if you're just in it for the money. It doesn't happen if it's just a pet project that you're doing in a classroom. It only happens if you're obsessed with the idea, if you're obsessed with the problem that you're trying to solve, and you really believe that you will make the world a better place, or at least a more interesting place, if you're able to execute.
You just spoke to something about, founders who have, recognized the void and they can, something that they can uniquely fill. How dialed in to the details of what that future looks like are the most successful founders? Like, can they talk about the intricacies or just the concept?
No, they should be really dialed in. I think that the best founders that I've seen, they can paint you a very, very detailed picture of what the world will look like if their product, service, business model, serves as a disruption to the status quo.
To a VC, what do you need to hear in those details that give you the confidence to say this lady, this guy is going to go do it?
Yeah, I mean, I think there's a few things that I'm looking for. So, and this is true for a lot of VCs, but one of the things that we first listen for is this problem a big enough problem that if the founder succeeds, it will create $1 billion company? They might be right about the problem and they could be super passionate, about it. But if it's a small problem, then it doesn't necessarily return enough capital for me or for my LP base for it to move the needle. And that's kind of where we get into the concept of, is this a venture backable company versus is it a small business or a large business that's a good idea, but maybe not a great idea for venture, because we need to have those scaled returns. So, first is this problem a big enough problem? The second thing that I'm usually asking is, what about this founder's background leads me to believe that they are going to be able to execute on this solution? So they might be right that it's a great problem and it would be awesome if somebody solved it. But why do I believe that you're going to be able to do it? Have you been thinking about this problem for the last 15 years? Have you worked on versions or iterations of this problem over the course of your career? Have you built prototypes, test models? Do you have a PhD in the subject matter, etc.? It doesn't have to be all of those things, but we're looking for some version of what we call founder market fit, which is, do we believe that this founder's, done the things in their career to give strong indication that they'll be able to solve this problem?
I would.
And
go ahead.
Go ahead. No, go ahead.
No, I was going to say, like, because I know you invest at different levels, seed, pre-seed, like, 100K to 3 million I've read in my research. And I want you to speak to along the lines that you're already on, but at how deep are you expecting them to be in at each stage? So if I'm asking for 100K, I'm assuming that you're not expecting as much as you would if I was asking for 3 million.
It's a good question. And I would say no, that's not true. For me, the dollar value doesn't correlate to the level of dialed in that I should see with the founder. If we're giving you money, it's more correlated to what the stage is of the business, and making sure that that we own a significant enough percentage of the company to match with our portfolio construction. But if we're investing, we usually don't go as low as 100K these days. But say we're investing a 500K check into a founder, that oftentimes means that the stage of the business is such that if we invested more than that, it would dilute the founders too much. And so, we typically don't want to take, more than 12% ownership with the first check. That being said, we'll happily invest more at the next round, at a higher valuation if the company continues to perform well. And so, I would not say that the amount of capital is correlated to our conviction level of the founder. Rather, it's just correlated to the stage of the business and how early or late, or how far along the kind of business trajectory the company is.
Yeah, you spoke to something that I'd like to bring back up, and you talked about the other value you bring to a startup, whether that's a network, whether that's CRM experience, et cetera. And can you speak to holding that in one part of your mind, then this other idea, which I'm a believer of, and I remember recently hearing a big finance guy say it. It's as hard to build a small successful business as it is a big successful business. And so if you think about that concept, most of us don't think that way. They think if I'm going to build, a $1 million business, that's going to be hard, but it's not going to be as hard as if I was trying to do 100 million. But it's hard is hard. So it's how big do you want to scale your hard? How much do you want to take on? But can you speak to those concepts of, what you believe you can bring to a business and the level of which effort you have to put in for not as much reward on the outside, or I might as well put my effort towards something that could be a bigger windfall?
Yeah, no, I mean, I think it's a great point. And I completely wholeheartedly agree with you. Sometimes it's way harder to build a small business than to build a big business. And I think the reason that is, the success of the business isn't just about the outputs. It's also about the inputs, right? So, if I raise $40 million and I create a business that is a $10 million a year business, some could say that that's successful, but other people say, well, no, you raised 40 to get to 10, that you lost a bunch of money doing that, versus if I raise $5 million and I get to a $10 million annual business, I would consider that significantly more successful. And so I think not everybody always factors in both the inputs and the outputs when they're looking at things. I think that that's especially important when you kind of observe the world through a racial equity lens, because, for the most part, Black founders, Latin founders who are women or have women on the founding team, oftentimes are significantly undercapitalized relative to their straight white male peers. And oftentimes they're judged based on the same output metrics. So oftentimes they'll say, oh, look at these two types of business models. They seem similar, but this company is, generating 5x the revenue. And, the first thing that I often ask is, okay, but did they raise 10x the amount of capital? Because if so, it's actually less impressive to get where they got. And in the long run, ultimately, it won't return actual money for investors, because investors have invested in so much. That business needs to not just, outperform their peer set, it needs to outperform their peer set at a multiple of the amount of dollars that were invested into the business. And so I think oftentimes it's important to look at what has this founder done with the resources that they have. Therefore, do I believe that if I put more resources into the business, that it will continue scaling?
That's really good. And so you brought up, racial equity and these things, and it makes me think about the landscape, the legal landscape of trying to support Black founders, women founders, Latinx founders. And even when you're talking about venture capital, whether you're talking about college admissions, colleges can't ask what your background is anymore. Talk about your thoughts on the efforts to support Black founders intentionally with venture capital, faced with the issues that we now are presented with.
Yeah, I mean, these are trying times, and it's hard as someone that's worked in many ways in the Black empowerment space for the majority of my career, whether as an artist or, with my time, founding Blavity. We've seen the pendulum swing back and forth a few times. I remember when we started Blavity back in 2014. In many ways, it was a direct response to what was happening in Ferguson, in response to the murder of Mike Brown, and then there was interest in supporting these types of initiatives. That interest winds down, and then it ramps up again with the murder of George Floyd. And then again, we see a lot of racial equity initiatives permeate throughout corporate America and the investing world in 2020, 2021, 2022. And then again, now we're seeing the pendulum swing back with a pushback against critical race theory, a pushback against affirmative action. But for those of us that are practitioners in the space, this is not new. Sometimes it's in vogue to support racial equity, and sometimes it's very much not in vogue. I think that the important thing for founders to look at is the people that have staying power, the folks that have said that they care about this work and have continued to do this work, whether or not it's popular. And I think that, there are companies like Blavity that, will support Black people, whether or not it's cool to support Black people. And I think that there's a lot of firms that have demonstrated track records in venture, of investing in people of color, corporations that have done this. And I think the most important thing to look for is look at people's track records over a longer time horizon. Don't just say, do you have a new initiative, or do you have a good press release, where you've made some type of dollar commitment, which, by the way, many firms made dollar commitments that didn't actually execute on those dollar commitments, right? So don't look at that. Look at the actual track record of work and say, okay, over the last 10 years, over the last 20 years, how many Black founders have you actually invested in? How many programs have you actually created? What were the actual dollars that were deployed versus the dollars committed? And I think that, folks rise to the top in terms of who actually has a track record of supporting women and people of color in this space.
There's this line of an article I read about you where the line is, Sam Ewells is a believer that the best endings to a story are both surprising yet inevitable. And I'm going to allow you to pick which you want to talk about with just that statement alone. But I think about how that can be directly related to so many things. Number one, you talk about Black people. I believe Black people ultimately find true generational wealth and success in our country and around the world. We will find our way to not be the minority. We will be that's just numbers. We'll be the majority, or not a minority, in less than 10 years, or it's 20, I'm probably about 18 years, 16 probably now. We will find success where we have not historically found it. People who are going to win in startups and business and et cetera, you can probably find indicators that say that person is going to win regardless whether or not I invest in them, because that's a winner. So that person is going to win. Aaron Samuels is going to win. Jeff Nelson is going to win. Morgan is going to win, whether or not, pick a thing. And so talk about what you want to talk about with just that statement. Like, what do you get? What do you derive from that statement?
Yeah, I think the clip that you're pulling that from is actually where I was talking about evaluating founders and helping founders tell their story to other investors. And I think that when you're pitching a deck, when you're pitching a company, I think that subtly that's what moves the needle on getting somebody else to be convicted in you. Is be surprising yet inevitable. I think if somebody walks away from your pitch as a founder and they say, oh, that caught me off guard, but also, yeah, that's definitely gonna happen. I think that makes me more likely to invest in you, because I believe the world is naturally going there anyways. But you surprised me because you're going to get there first, or you're going to get there differently, or you're going to get there better. Of course, I think that that's true more broadly than just founder stories. I originally kind of paper clipped that expression from something that we used to say a lot in the poetry world in terms of an ending to a poem or an ending to a story is surprising yet inevitable. But I think that that's what leaves you at the end of a presentation or at the end of a story, like the wind is sucked out of you a little bit. And I think it's that emotional feeling oftentimes that drives a lot of investing decisions.
In that same article, they had this phrase in there. It was called, "You like to invest in people building generational companies." And so, is there a balance between, hey, this is just a great financial play, but it's probably not going to be here in 20 years, or we want to be along for the long haul?
Absolutely. And look, there's a lot of different business models in kind of venture and the broader kind of private equity space. If I invested later stage, if I invested at Series D, Series E, Series F companies, I wanted to be along for the ride for 3 years and then they go public and then I cash out. That is a very different type of business model. And of course, there might be opportunities to participate in projects like that in a one-off basis. But the reality is when you invest at the seed stage or when you invest at the pre-seed stage, you're signing up to be with these companies for a 7 to 12 year journey on average, sometimes longer. I know seed stage managers that have held positions in companies for 20 years before cashing out. And if you're thinking about the world that way, I mean, 20 years is a generation. Like that, you could see full turnover of team, of culture, of product. Even just, think about what you were doing 20 years ago. The world was completely different. We were listening to Nelly, perform videos on 106 in Park. People were slapping pogs. Instagram didn't exist, Vine didn't exist. People were playing with Tamagotchis. The world was a different place. And so when I say that, though, just as a reminder, the founders that I'm backing today are potentially going to be building companies that'll play in a world 20 years from now. So if we imagine how different we are now than 20 years ago, you're really taking a big bet on the future. And I believe that the only way to successfully invest at the seed stage is to have that long view.
Yes, it's so funny you said that. I'm actually rewatching The Wire, and it was 20 years ago when that came out. And I'm looking at the tech, and there's this like, it's so fascinating. That was just 20 years ago, and you have payphones and beepers and like just little Nokias. Like it's so wild how fast this stuff changes.
Yeah.
And so you talked about something in that statement there that you can invest at Series A, B, C potentially, and you're talking about investing at seed and pre-seed. Is that ability to, because a lot of people in the venture capital space pick one of those or maybe two of those, but is that particularly because you raised a big round? I mean, one of the largest Black-owned first-time funds at 66 million. Is that ability to invest at such a wide category purely reflective of the amount that you raised?
Not purely. I mean, I think the amount that you raise has something to do with your strategy, but it's not the entire thing. I would actually flip the order. We knew that we wanted to invest at the seed stage first, and so then we raised a fund that we thought would be appropriate for the stage that we wanted to invest in. We had a proof of concept fund. We did 35 companies. Now we're running fund one. We're going to do 35 companies in that fund. Then we're going to raise another fund, probably going to do around 35 companies again. And so we think that kind of playing in the 60 to $100 million fund size window is appropriate given the amount of companies that we want to back over the 3 to 4 year time horizon that we want to invest in them.
So when you're talking about the LPs that you deal with, and there's if you picked the category that you're in of the level of VC firm that you have, let's say around $100 million. There's a lot of them. There's, what is the LP thinking about? I'm going to invest in Collide versus Acme firm. What is the differentiating factors that they're looking at?
I mean, I think they're looking for a lot of things. I think most LPs are looking for, first and foremost, a history of strong performance. So they're going to want to know, how did your previous funds perform? Have you consistently returned money to your other LPs? Outside of that, oftentimes they're looking for some type of competitive edge or competitive advantage. Usually that means you either have access to unique communities that they don't have access to, or you have some type of expertise that makes you a better selector. You know, have you spent time in an industry? Do you have, a specific level of training or education in a particular way of thinking? But do you have access? Are you going to be a great picker? And do you have a history of performance?